Good morning, everyone. Welcome to this update for the 11th of December for global stocks and commodities. And we had another very big week overseas, in particular, to a certain extent in Australia, although the stocks that are participating in the Australian rally are pretty limited. It's a pretty narrow field in Australia, but overseas it's very broadly based. And it's not just the US, it's Europe as well, and also China. So we've certainly seen the fear that was prevalent in the earlier parts of this year, and certainly immediately after Trump was elected, that disappeared in a real hurry, and we've now seen that fear turn to optimism. In the short term, it's probably a bit overdone, so we probably should expect some sort of near-term pullback, but it would appear that we've got a very bullish period ahead of us, albeit probably with some ups and downs. And of course, this situation has really put a pinprick in the precious metals market. And we've just got to stand back, and whilst it might defy the rational fundamentals, we've got to accept what the market is telling us. And certainly precious metals remain out of favour. And as we'll see with gold, broke some key support. So you may need to do some adjusting to your balance in view of that. So let's get on and have a look at what happened in the last week. But first of all, just a couple of general comments at a big picture level. We saw resources starting to rise in the probably the second quarter of this year. I think it was against disbelief for most people. We saw iron ore absolutely rocketing up, and everybody said, including BHP and Rio, said this can't continue. Yet iron ore has continued to go higher. Copper's continued to go higher. Oil's rebounded against a backdrop of significant oversupply. And I guess this is the way that the cycles work, that the market starts to price in how they view the future. And so the rising resources is definitely a very strong sell for economic revival. We've seen it in base metals, copper, nickel, zinc. We've certainly seen it in oil, which is back up from $30 to $50. We've seen it in natural gas. And of course, we've seen it in coal and in iron ore. So it's pretty much across the board. And that really, it would be hard to be negative from an economic point of view with those rising resource prices. Now, also, since the US election, we've seen some very abrupt sector rotations, and we've seen the end of the 5-year trade in or focus on yield stocks. So people weren't too worried about growth. They just wanted to protect their money. They wanted to get a dividend yield. That's all fallen apart fairly quickly now that the interest rate cycle is turning up. And so in general terms, we're seeing a move from yield stocks into growth stocks. So if you've still got a whole cupboard full of yield stocks, then you would have already suffered significantly on the capital value side. And I don't think it's going to get any better, and it could get worse for you over time. So if that's the way that your portfolio is balanced, then I suggest strongly that you better revisit that. Growth stocks, to me, are where the great opportunity is. However, in the short term, particularly in America, we've seen economically sensitive stocks, particularly banks and other financials, insurance companies, have really surged. And that has, and also we've seen a surge, obviously, in what's called the Trump trade, which is construction stocks and other things related to a resurge in America. And what that has done is that it's sucked money from elsewhere. And we've seen, and I commented last week about the FANG stocks, Facebook, Amazon, Netflix, and Google, which had been market leaders for so long, had been real lagging stocks in the last few weeks. And I don't think that's because people have turned negative on those stocks. It's just that the money that has absolutely flooded into particularly the finance sector had to come from somewhere. And so there's been selling in other sectors. Now, I don't believe that's something that's going to be sustained, certainly not at this rate. So for me, the longer term, once things settle down, would be growth stocks, definitely, which are currently lagging. and especially technology stocks are going to dominate. So to me, I think going forward, that's the big opportunity. American stocks for the week, the S&P index had another powerful week, up 55 points. That really is that's a major gain, as we'll see from the chart. And there's been just some extraordinary momentum behind the American indices and also the European indices as well. But look, after such a run, they're heavily overbought, they're overstretched in every short-term dimension. So I strongly recommend that you don't buy into it until we get at least a bit of a pullback. I don't think it's going to be much, but you never know. This has run so hard in such a short space of time. Just give it a chance to settle down. I think you'll find there'll be a much better opportunity coming very shortly. In addition, we've got the US Fed meeting on Wednesday, and it's almost certain that the Fed will raise rates. I think it's about a 98% priced into the financial markets, and people are wringing their hands a little bit because when the Fed last raised rates, which was December in 2015, we saw what happened in January and February. The stock market was awful, and we had a very sudden plunge. But I think the circumstances are quite different now to then. And Donald Trump and the way that the American economy is and the way that people are perceiving that things will unfold is certainly a part of that. It's not the only part. I think the economic revival in America was underway already, and some of the other big picture drivers were underway already. But certainly Trump policies will accelerate that. But history shows that stocks do rise when rates start rising, provided, and this is the big proviso, that the earnings growth is there. So it doesn't happen every time because sometimes interest rates start rising when the economic growth and earnings growth isn't there. But this time the growth is still there. So I have no real qualms about the fact that the Fed's raising rates. Now, the Trump agenda, as I've indicated, is certainly providing a spark for this extraordinary rally, but improving fundamentals were already in place. And so growth stocks, they're not currently in demand, which is a good thing in a way because it means that they haven't roared off. It means we've got an opportunity. And I think that's one of the best areas of focus. Now, higher interest rates do impact stock prices, but you've got to get above a certain threshold. The US 10-year yield is currently at 2.46. Is that above 3%? Is it above 4%? We won't know until we get there. But I think we're well short of where higher interest rates would impact stock prices because there's still too big a differential between the 10-year government yield at around 2.5% and the earnings yield of most good quality American stocks, which is closer to 6%, 6-7%. So there's still a big gap there. So I'm not too concerned from that perspective. What will determine what happens to the stock market is the rate of the increase and the way the economy is performing. And I don't think there's any reason to suspect that unless we get an enormous inflation breakout all of a sudden, that the Fed is going to ramp up rates too quickly. But certainly the market will be looking very, very closely at the comments that go with whatever change they make on Wednesday. Now, when you look at sentiment, and I find this number a bit hard to believe, but I'm just reporting the facts as I understand them. There's a level of one of the most authoritative survey organisations in America has said that investor bullishness actually fell slightly in the last week. Now, whether that's because people have seen this rally run so far and are getting cautious about it, it's quite possibly down to that. But look, the important thing is that at 43%, it's not over the top. It's not 60%, which is really quite high levels of bullishness. So again, this is just not a place where you tend to see market tops form. If we look at other markets, the Chinese stocks, this is kind of flying under the radar a little bit. Chinese A shares have been outperforming the US in the last month. and that confirms what was already in place, and that's basically about a 6-month uptrend. We've seen the DAX breaking out with a very, very strong surge, particularly in the last week since the ECB extended their bond buying program. And if we look at which US sectors where I think the best fishing may be, I believe that domestically focused stocks in preference to multinationals are probably going to be where the best growth is going to be, and that's because it really does appear with the Fed raising rates and the ECB and Japan keeping rates where they are and continuing with their bond buying programs, that the US dollar is probably going to keep rising. And that's going to be a drag on earnings for multinationals. So that's why I think domestically focused stocks in America, the ones that get most of their earnings from domestic activities, are probably going to be a better bet. Technically, and we'll get to the chart in just a minute, we've seen new highs on the indices. We've seen breadth jump very sharply. This is not a handful of big stocks taking the indices higher. This is across the board. It's very impressive. We've seen the Dow Transports Index break out, and that's a highly reliable longer-term signal. So a lot of positives. For me, 2400-ish on the S&P 500 has to be in play, but we're currently at 2270. Don't expect it to be in a straight line. Markets are stretched. Expect volatility. The Russell 2000 small caps leading the way, and historically that's a very bullish indicator. So we've got a lot of charts to look at here. So let's jump in and take a look. We'll start with the S&P first of all on a monthly basis. So 2009 here. This is the bottom in 2002. So you can see that once this uptrend from the GFC got into stride, it's gone up in a pretty well-defined channel, and it's getting towards the upper part of that channel, but it's still going. And who knows how much further it will push on. If we zoom in a little bit on the daily, you can see just how strong. Let me just clean this up a little bit. You can see just how strong the last few weeks have been. We've broken that, so I might as well take that out of the way. As you can see here, we're really quite overbought on the RSI. It's been a massive move since the 4th of November. But look, who knows how much further it'll run in the short term. But certainly you wouldn't want to be buying it up here. If we look at the Russell 2000, just pan back and take a bigger look. Now, we've got this huge broadening top formation, which a lot of people were getting very concerned about. A lower high, we then got a breakdown. We broke down below these swing lows here of September, and this really was looking very ugly. And I think on that particular week in early November, my weekend video would have reflected that this was an ugly break, and it looked very nasty for American small caps. The election of Donald Trump has just turned this around to an extraordinary degree, and one of the reasons for that is that there are a lot of financial stocks, a lot of US domestic financial stocks that are in the Russell 2000, and that's why the Russell has done so well, because those smaller banks, insurance companies, life assurance offices, etc., have constituted a fair part of this. It's an amazingly strong trend. Let's look at the Nasdaq. Now the Nasdaq has relatively lagged up until the last couple of days. In fact, it looked awful. So the Nasdaq heavily reflects big technology and also the healthcare and pharmaceuticals. So they've been out of favour, or the money's been flowing into the banking sector. I think that's probably done. One would think the money that is rotating from those sectors is probably done, because it's technology and healthcare where the major earnings growth has been. At the moment, the market is ignoring the facts about that earnings growth in favour of the perception about what Trump may be able to accomplish. Now, I don't know about you, but I prefer to go with facts and things that are currently known rather than the maybe of what Trump may be able to achieve. So for me, rather than betting on banks continuing to rocket ahead, I would prefer to be betting on technology and possibly even healthcare, which is a sector that's been beaten down very hard for the last 18 months or so. So that's where my bets are. If we look at the US dollar, you can see we're now holding above the 100 mark. So we broke above 100, we came back, we retested it, and we're heading off again. So a lot of strength in this US dollar. If we pan back, you can see we're now at highs that were last formed in 2002. So we're now starting getting back to a situation that hasn't existed now for nearly 15 years. The faster this goes, the further it goes and the faster it goes, the more stress it puts on the large cap American stocks. So it's certainly something that needs to be watched closely. Just looking at the DAX, German DAX index, you can see the very strong run that we had. So we had a downtrending channel there in the DAX, which started in April of 2015. We've broken out of that downtrending channel. We consolidated for a period. We came back, we retested several times the top of that channel. But now you can see we've now busted out of that. And that was a very, very strong week for the German DAX. And the FTSE looks somewhat similar. Not quite as strong, but certainly similar. So certainly a lot of very positive things happening out there at the moment. If we look at the VIX index, you can see just how strong this VIX index is. How relatively low the VIX index is. We're down really to the levels. We're under 11 now. We're down at 10.85. It's really there's virtually no fear in the market at all at the moment, and that plus the rising US dollar is what has punctured the precious metals. Turning now to Australia, the Aussie dollar was steady around 74.5. And our index managed to put on 115 points for the week, but that was mainly about the banks. We've seen some more very brutal price plunges in stocks that miss expectations in any way. Some of them have some substance to them, and therefore they warrant the shellacking, but most of them don't. It's a quarter of a slowdown, or it's a half year of a slowdown. It's some sort of transition in the business. Doesn't warrant a 30 to 35% price plunge, but that's what we're seeing in Australia. And as I covered last week, there is a solution to this. If you're fed up with it and you're looking for a way of insulating yourself from that, I talked about it last week. I'll touch on it at the end of this video again. There are things that you can do. You don't have to be at the mercy of the market with this. But much of our market has really gone nowhere. The rises in the ASX 200 have been largely about the banks and to a degree about the major miners. There's so much of our market is just not trending at all. So let's take a look at the XJO, the ASX 200. Now, quite a strong rise from the lows that occurred around the Trump election. So we've got back up to the top of this channel, but look, we still are stuck. If you pan back, we've been stuck way down here for such a long time that it's hard to be bullish about the Australian index getting back up above 6,000 points. Turning now to precious metals. Gold was down by another $17, broke important support. So this is a concern for me now. Defies the fundamentals, but It is happening, and we can't ignore it. Silver fared relatively better. Silver has not broken down from key support. But look, at the moment, and I covered this last week, the two things that we needed for precious metals to do well was a fear in the market and a real pickup in inflation. Now, I think there is a pickup in inflation, but it's not really being acknowledged yet by the market as a concern. And certainly there is no fear in the market because of all the positivity that's around Trump. And you just see it when Trump first won the election, gold spiked by $50 an ounce. Now that only lasted a few hours, and as soon as his victory speech came and the market started to look at him through a different set of eyes and thought, gee, he may be able to pull this off, then the bottom just fell out of gold. And since then, it's been a case of selling has caused more selling, and we've just got in this downward spiral with gold. The fundamentals would dictate that gold shouldn't be doing what it's doing, but look, it is, and it could head lower yet. In fact, there's every chance that it will. So the fundamentals don't matter. The commitment of traders report doesn't matter, even though that's now the level of speculative longs is now getting down to quite a modest level, the sort of level where we could expect a bottom. The holdings in the ETFs don't matter. Just all of that consideration doesn't matter. The only thing that's relevant is that people are selling and prices are going down, and that's really the key thing that you need to understand. For people that are very positive on precious metals, it's a bitter pill to swallow. I understand that, but it is what it is. Here's the US dollar. Here's the US dollar gold price. If we put a Fibonacci retracement scale on this, we had a level at a level here at 1250, which was the first point that the market got to. So that was the 38.2% retracement. We pulled back to 1250. We bounced quite hard. The next level was down at the 50% level, which was at 1212. And the market basically went straight through that on certainly on a weekly basis. I think there was a couple of days where it stabilized. And then the third level is the 61.8%, which I was hoping that it wouldn't get down there, but I thought that would be a key support at 1176, and that the market was likely to hold there. And if it did, then the bull case is still intact. The fact that we've now broken that, as you can see in the last day or so, as we'll see on the daily chart, it's a big deal. This level really should have held, and it's quite feasible that we could see gold head now below 1100, and that would not be pretty for gold stocks, I can tell you. So there you can see we'd held 1173 for a little bit, but we finally broke below it on Friday and closed emphatically lower. Now, there's a lot of reasons why we might see a near-term bounce, but you still can't get away from the fact that we have a very strong downtrend here, and the path of least resistance is to the downside. This is silver. As you can see, silver has fared much better, and there's a bit of a positive in there. But in the face of a strong downtrend, we just can't keep hanging our hat on some sort of slim hope that this is not happening. Let's look at GDX as an indication on gold stocks. So we've broken the 50. We haven't broken the 61.8% yet, which comes in just under $20. Who knows? We might find stability and turn up from here. But look, my strong recommendation is that you need to adjust your exposure in light of the fact that we've most likely got more downside in the precious metals market. Turning to other commodities, copper advanced slightly to $2.65, and that was despite the rising US dollar. So this is very impressive from base metals. Crude oil hit resistance at 52. It retraced a little, as we would expect it to do. We haven't had it yet, but just looking at the price action, I think a breakout looks to be the most likely outcome for me. There's a picture of the crude oil price on a daily chart going back to 2015. You can see that we've formed up this rising wedge, and therefore most likely that at some point will break to the upside. We've had a minor little false break above. We may even pull back to between 49 and 50, but I think the odds certainly favour an eventual breakout. There's the copper chart. Hasn't changed a great deal in the last couple of weeks. So to wrap it all up, this is what I had last week. So just a reminder, there is a solution to what we're seeing in Australia. We're not seeing this in America to anywhere near the same degree. In fact, not even close to the same degree. It is an issue in Australia. It's down to the algorithmic traders. Our market is just responding in a very unfortunate way. There are things that you can do to insulate from the big individual stock plunges, and there are things that you can do to insulate from general market volatility. As I said at the start, you don't have to sit there and be a victim of this in the Australian market. The big opportunity for me is in growth stocks. I'm really bullish and really excited about the opportunities in 2017. You've still got to buy the dips. You've still got to be patient. You've still got to select well. This is not going to be a rising tide that's going to lift everything up. But the genuine growth stocks, and particularly in technology, are where I think the big opportunity is. They're currently a bit out of favour because of the money that's flowed into the Trump trade, but that'll settle down. So technology is the theme, and also I think maybe healthcare might be at the start of a bit of a resurgence as well. Wait for the hot sectors to retrace. I'm not saying that the uptrends in construction and banking and some of those other areas will not continue. I think it will. There's just so much power behind it. I think those trends will continue. However, they're so overdone right now that you'd be crazy to buy into them. Let them settle. So that's it for this week. There's my contact details for non-members. It's quite possible with the Fed meeting this week, we might see a pullback and then a couple of strong weeks into the end of the year, as we typically tend to see. So that's it for this week. Talk to you next weekend for what will probably be the last video of the year. We'll just see what's going on at the time. That's it for this week. Cheers.